A significant difference is showing up in the apartment rent growth stats between the nation's largest markets and the smaller markets, and we're going to look at that in today's episode of Apartment Market Dynamics. He's Greg Willett, I'm Jay Parsons, and we're going to be telling you about the differences in rent growth by market size. So Greg, why don't you walk us through the basic stats here?
Well, Jay, back at the beginning of July, we released second quarter numbers, and what we showed was annual growth in effective rents for the nation's 100 largest markets was an even 4%. As you slice and dice the data, in fact, a lot of the variations that we'd seen previously seems to be going away. If you look at product age categories, they're pretty much all pretty close to that 4% mark. And even if you look at regional numbers, certainly variation from one metro to another, but regions overall pretty close to that 4% number across the Northeast, the South, the Midwest. The West number is a little bit higher at just over 5%, but if you took out the huge growth that you see in the Bay Area, that region of the country would be around that 4% mark as well. But there's still one category where you see a lot of difference, and that's by market size. For the top 50 markets across the country, annual average rent growth now is 4.2% versus the next 50 markets on the list, that number's only 2.5%.
And Greg, we should point out that these smaller markets tend to post less rent growth in good times, but also cut rents less in bad times. But what makes this cycle particularly interesting is that the gap between the two has become so large. And so in looking at that, we're trying to figure out what's happening. So we launched a little bit of a quest to try to pin that down. And basically what we found is that some of the most obvious reasons to look at really don't tell us much. Let's start with the occupancy story. Obviously, you'd expect to see some variation in rent growth momentum if there was a big difference in occupancy rates between large markets and secondary markets, but that's really not the case. Occupancy now is at 95.2% in the nation's 50 largest markets, and it's basically the same level, 95.1% in the bottom 50 markets. And so furthermore, the pace of occupancy growth of the past quarter and the past year really don't show much variation either. So it's not an occupancy issue. Maybe it's an economic issue. So we went looking into the recent job stats, and it's not that either. The big markets have added jobs at a pace of 1.3% over the past year, and the smaller markets, almost the same number, 1.2%. And those similarities in job growth pretty much also eliminate any possible gap in the loss of renters to home purchase between large markets and secondary markets, since we tend to see larger losses to purchase in markets where job growth is more significant. So, Greg, what does that leave?
I think it leaves the big category that's hard to quantify, and that's operator behavior. So just kind of digging down into the nature of these markets, what you see is when you get to the smaller locations, you have a lot of owners and operators who are locally or regionally focused versus in the big markets, you're going to get some national players, you're going to get some institutional money. I think when you're looking at the smaller markets, that means that the people are there locally. They're actually having those conversations with the residents when you're adjusting rents and hearing the pushback after a couple of years of solid rent growth. They're hearing that firsthand. So I think that makes them a little bit more cautious. Another factor that comes into play, probably, Jay, you and I, we work for a technology company, so we always think about is technology an answer to any of this. And I think maybe that is coming into play in this case as well. As you look across those big markets, penetration of revenue management systems, so statistical modeling to help make pricing decisions, that's much further along than it is in those smaller markets. And so I think in the big markets, we've had a tendency to maybe take the emotional component out of setting rents, maybe more so than in the smaller markets.
And Greg, we should point out that there's always exceptions to every rule. And so let's highlight a handful of smaller markets that are actually showing some notably strong rent growth. The top three by far are Grand Rapids, Michigan, where annual rent growth is at 6.7%, Harrisburg, Pennsylvania, right behind at 6.6%, and Corpus Christi, Texas, with a year-over-year increase of 5.5%. And Greg, I'm sure that you had called Harrisburg to be on that list, and it is a market that's near bankruptcy, so obvious choice.
Sure. I'm all about Harrisburg.
All right, so I don't know that Harrisburg is going to stay on the list of rent growth leaders going forward, but we will be tracking this broader trend, the differences in rent growth by market size over these next few quarters. That's all we got for now, so until next time, for Greg Willett and for MPF Research, thank you for watching Apartment Market Dynamics.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.